Okay, let's dive right into this explainer. We're going to unpack the invisible engine that literally keeps our global economy humming along, even when massive catastrophes strike. We're talking about the insurance industry. Now, I know, usually when we think of insurance, we're picturing endless paperwork or, those annoying monthly premiums. But today, we're flipping the script. We're going to look at it through the lens of global sustainability, using the exact official standards that guide the entire industry.
But before we get into the nuts and bolts of it all, I want to pose a question to you. What if the very safety net designed to protect us is actually making the world more dangerous? I mean, it sounds like a total paradox, right? We build these incredible financial structures to catch us when we fall, to save us from the absolute financial ruin of a car crash, a house fire, or a sudden medical emergency. But as we'll see today, the mere existence of that financial safety net can have some massive, totally unintended consequences on human behavior and ultimately on our planet.
Part 1. The engine of society. To really understand how we arrive at that paradox, we need a quick refresher on how this system actually works at its core. Basically, the whole insurance industry operates by taking the devastating financial blow of an unexpected shock, like an illness or a bad accident, and moving it away from the individual. It's a three-step dance. First, you transfer your personal risk. Second, that risk gets pooled together with millions of other people's risks. And third, the financial burden is shared across that massive pool. By doing this, society essentially builds a giant economic shock absorber. Without it, literally every single accident could mean personal bankruptcy. But because we pool and share the risk, the economy keeps moving forward.
Now, what's fascinating here is how investors actually evaluate an insurance company's sustainability. They use guidelines from the Sustainability Accounting Standards Board, or SASB, and hidden right inside these official, dry industry standards is the acknowledgement of a massive built-in glitch in our economic engine, a glitch that directly impacts global sustainability.
Part 2. The moral hazard glitch. Think about your own behavior for just a second. Have you ever caught yourself driving maybe just a little bit faster or squeezing into a slightly tighter, riskier parking spot simply because you know you have full coverage auto insurance? It's completely human nature. Think about it. If you knew that a tiny fender bender would literally cost you your entire life savings, you would drive like you were transporting fragile glass. The absolute safety provided by the policy actually changes how safely you operate out there in the real world.
And this brilliantly illustrates our glitch, which the industry formally calls moral hazard. Basically, when people or huge corporations are totally shielded from risk by a giant financial trampoline, their natural incentive to act responsibly drops. For example, if a massive factory is completely insured against environmental disasters, they might just decide to skip spending the extra millions to upgrade their safety valves. So the insurance that was designed to protect them inadvertently contributes to negative sustainability impacts, all because it reduces the drive to improve their underlying performance.
Part 3. Incentivizing responsible behavior. So the industry isn't just ignoring this glitch. They're actively trying to fix the moral hazard problem by completely turning it on its head. Now, traditional insurance is entirely reactive. It just sits there, collects your premiums, and pays out a claim only after the disaster has already happened. But sustainable insurance flips the script. The industry realized, hey, we are in a totally unique position to generate positive social and environmental outcomes here. Instead of just waiting for the crash, they're baking specific clauses and pricing structures right into their policies to proactively incentivize health, safety, and environmentally responsible actions way before a disaster strikes. They're literally turning the danger of moral hazard into a powerful tool for societal good. And we see this in specific real-world examples directly from the SASB standards. This is how the patch actually works. You get premium discounts if you build a green building or improve your property's resource efficiency. If you buy a low-emission or alternative fuel vehicle, your premiums drop. They offer discounts if you simply drive less or prove you have safe driving habits. In the life and consumer segments, they even offer financial incentives for maintaining a healthy diet, exercising routinely, losing weight, or finally quitting smoking and drinking. Your insurance premium is directly tied to living a safer, greener lifestyle. They are literally paying you to reduce your own risk. But this goes way, way beyond just our personal, daily habits. The industry is developing entirely new policy products designed specifically to enable the green transition on a massive global scale. According to the standards, insurers are now actively tracking the premiums they write for energy efficiency and low-carbon tech. We're talking about underwriting specialized protection for gigantic renewable energy projects, insuring against unpredictable fluctuations in wind or solar power, or even writing energy savings warranties for building retrofits and carbon capture tech. They are deliberately absorbing the financial risks of these brand new experimental green technologies. Why? So those projects can actually get funded and built in the first place.
Part 4. Pricing the planet's risks.
Now let's zoom out even further to the macro view and look at the colossal systemic threats facing our entire planet. There is a very stark quote from the standards, and it highlights the harsh reality the industry is facing. Catastrophic losses associated with extreme weather events will continue to have a material adverse effect on the insurance industry. Obviously, climate change is ramping up the frequency and severity of extreme weather. We're talking hurricanes, floods, massive droughts, you name it. If the insurance industry fails to fully grasp these massive environmental risks and fails to price them accurately into their underwriting, they are going to face way higher than expected claims. Ultimately, if they don't price the planet's risks correctly, the entire financial safety net that our global economy relies on could literally face catastrophic failure.
So, how exactly do they calculate the survival of the safety net? With some seriously intense mathematical modeling. The industry uses a framework to calculate something called PML, or probable maximum loss. They run probabilistic catastrophic models to simulate terrifying events, like tsunamis, major floods, or extreme heat waves, and then they estimate the financial devastation. They map out scenarios based on exceedance probability, so a 1 in 50-year event, a 1 in 100-year event, all the way up to a massive 1 in 250-year catastrophe. They have to know exactly how much a once-in-a-quarter-century megastorm is going to cost them, down to the absolute dollar, across totally different geographical regions. And calculating that gross probable maximum loss is definitely not just some academic exercise. The outputs of these intense climate risk models directly dictate the industry's real-world underwriting decisions. It determines how they price their policies, sure, but more importantly, it dictates client selection. It decides which geographical markets actually get coverage and which ones are left out. Because of these models, insurers are actively writing in clauses that demand climate risk adaptations. They'll financially reward coverage for properties and communities that enforce strict climate-resilient building codes or buildings that use sustainable materials. Basically, they are using their massive financial leverage to essentially force communities to build safer, stronger, and greener. Which brings us to our final thought for this explainer. We started out by asking if the safety net makes us reckless, and we've seen the very real moral hazard that it can create. But we've also seen how the insurance industry is actively rewiring that hazard. They're using premium discounts and strict underwriting models to financially incentivize everything from eating healthier and driving greener to building climate-resilient cities and funding experimental carbon capture tech. So I want to leave you with this one question. If the invisible engine of insurance has the power to change our daily behavior and literally dictate how our cities are built to prevent disaster, what kind of future is the ultimate manager of risk quietly engineering for us? Definitely something to think about the next time you see a discount on your premium. Thanks for joining me on this explainer, and keep learning.